Let's touch on something while we've got you on the channel here that no one's really talking about, and I'd love to hear your take on it and what the implications are. U.S. Treasury yield has just topped 4.2% for the first time since 2008, yet you're not hearing about that anywhere. Why not?
So, yeah, we did see the Treasury yields, especially the 10-year Treasury yield, top 4.2% since the 2008 crash. Now, we have fallen since then, and the question is, yeah, what you're saying, why? So let's explain what that means first, and then I'll explain kind of the implications of that. So the government needs money always, and a treasury yield is a loan to the government. So when the government needs money, they can issue these treasury bonds, which means it gives you an opportunity, investors, institutions, anyone, to loan money to the government. Well, when a lot of people are confident in the government, they feel strongly about the dollar, they're very confident that the government is strong and the dollar is strong, there's a lot of people that want to buy it because they feel that the treasury bond is very safe. And when a lot of people want to buy these bonds, the yield, the interest rate that you get for your loan to the government falls. Well, the opposite also happens. When people are worried about their dollar, when people are worried about the health, the economy, then there's less people that want to buy the treasury bond, meaning there's less people that want to loan money to the government. When less people want to loan money to the government, that doesn't mean that the government is going to stop their operations. They just got to incentivize you to loan more money to the government. How do they do that? By raising interest rates, meaning they raise the interest rate that they pay you. They raise the yield. We're not talking about the Federal Reserve Bank interest rates. So what we see is when people are worried about inflation, they're less likely to loan money to the government because inflation literally means the value of the dollar is dropping. So in October, there were a lot of fears of inflation, and the inflation fears really started to hit the bond market because we saw less and less people loaning money to the government, less and less people buying treasury bonds, which resulted in treasury yields rising. There's a lot of different types of treasury bonds, but there's one called the 10-year yield, the 10-year bond, which is often referred to as the investor confidence bond or a recession indicator bond is what some people like to call it. Because when people are not buying the treasury bond, it could indicate investors worry about the economy, which could indicate a potential recession. And what we saw happen in October is we saw the 10-year yield jump up to 4.2%. Now, the reason why that's a significant number is because when we hit that in the 2008 crash, that was the breaking point in terms of interest rates, which then led to financial institutions collapsing. It was a little bit after that happened that we saw Lehman Brothers collapse. It was within 6 months after the 10-year yield hit 4.2%. So we hit 4.2% in, I believe it was late October, if not early November of 2022. And very few people were talking about it. I did talk about it on my channel, but what does that mean? Well, obviously it doesn't mean anything. It's just an indicator, but it kind of shows you that, the investors are starting to be more worried about inflation. Now, of course, since then, it has fallen. Why? Because the November inflation data came out better than expected, meaning inflation came out cooler than expected. And now everyone said, we're safe. Inflation is gone, nothing to worry about. The Fed is no longer going to raise interest rates. So that then kind of flipped the bond market. But I wouldn't say that inflation is no longer a concern. It's more of understanding how these factors play together, because the higher interest rates then impact everyone. Well, higher interest rates mean higher expenses, and there is an absorption time. And this is something that I don't know how to explain it, but this is something that I kind of coined, the absorption time, where you got to, interest rates have more than doubled in 2022. Like in the beginning part of 2022, if you wanted to get a mortgage, we're talking about under 3% for a 30-year fixed rate. Now we're talking about over 7% for a 30-year fixed rate. There's an absorption time for that to hit the housing market. There's an absorption time for these higher interest rates to affect corporations, to affect startups, to affect consumers. And so while we're trying to absorb 7% mortgage rates, the Fed is still working to raise interest rates, which means it's going to take time for our economy to feel the real impact of these higher interest rates. It's not just that you raise interest rates and that's it. It's you raise interest rates. Now, corporations' debts readjust at the higher interest rate. People's debt readjust at the higher interest rate. Our government's debt readjust at the higher interest rate, which causes the expenses of these entities, people, corporations, and the government to rise, which then cause more economic issues. So this is something where if we keep our interest rates where they are, this is not like a 2023 thing. This is something that over the next number of years that we're going to see the impact of higher interest rates, because for the last decade and a half, we've been in a very cheap interest rate environment, essentially 0% interest rate environment, which means that, for the first time, we could be entering an interest rate raising environment, interest rate hiking environment, which we haven't really seen since before the 1980s. And that could completely flip the dynamics of the economy, at least in the short term. And in 2022, at least, it was a very drastic increase, which will have consequences. And we'll see what that means in 2023 and 2024.